This chart right here is exactly why you need to have some sort of self-discipline or an exit strategy in place. Big losses hurt more than gains of the same amount. It is not only true emotionally, but maths also can back this up. Once you understand the importance of this chart and what it tells us, you can save yourself a lot of future heartbreaks. This is typically called the break-even fallacy or the sunk cost fallacy. What it's telling you is that if a stock that you have loses its value by 10%, then from that price point onward, it needs to increase by 11% for you to break even or get back your original value that you have invested. If, however, the stock price goes down by 20%, it actually needs to increase by 25% for you to break even. If it goes down by 50%, then from that price point onward, it needs to increase by 100% for you to break even. And if you continue that way, if it goes down by 90%, then it needs to increase by 900% for you to break even. If you want to do the maths yourself, then all you need to do is open up a spreadsheet file, plug in some numbers, put some calculations in, and you can actually generate a chart that looks like this. Anyway, why am I even talking about it? Well, in my own personal experience, what I've observed is that when it comes to us investing money or thinking about buying a stock, we do tend to think quite a bit about it. We go away, do a little research, and even if we love the company, we sometimes wait until we get to find the right price for us to hit that buy button. And that's absolutely fine. But what it's telling us is that it's much more easier and is common practice to think a lot more about buying a stock than it is to actually selling a stock. Yet, both are equally important because as humans, we're not short of any biases. Sometimes we cannot help but be so in love with a company or a stock that we never want to sell out of it, even when it is getting hammered and for very good reasons. We try to reason with ourselves and look out for conforming news that the stock price has to come back up at some point. And even on the contrary, when the stock does really well and meets our price target, we delay taking profit because of momentum bias, which leads us to think that the stock price can climb up even further, and we don't want to miss out from an even bigger gain. So in a nutshell, we have natural tendency to do exactly opposite of what we should be doing. Now, to help us help ourselves and for investors to tackle these inherent biases, what they do is set some self-discipline. And when it comes to selling stocks, it is called a self-discipline. And from my own work experience, I have seen firsthand just how a lack of self-discipline can actually explain a lot of the underperformance that we see in active fund managers. So in this video, I do want to talk about this very important point, especially to think about how we should be framing our self-discipline when it comes to buying a stock, and especially to think about what sort of factor we need to take into account when it comes to selling a stock, and really help us to distinguish the difference between taking profit and selling a stock outright. It's a very big topic and can get quite technical, but I'll keep it very high level so that it is easy to follow. But firstly, self-discipline. What does it even really mean? Self-discipline refers to a list of concrete factors that you think about and decide on before you invest your money or before you go ahead to buy a stock. So while you hold a stock, if some of these factors gets triggered, you automatically know that it's time to sell or take profit. When it comes to self-discipline, we should be thinking about it from a single stock point of view as well as your overall stock portfolio. Here are a couple of examples for both, starting with your overall portfolio. Number one, rebalancing needs. One of the reasons why you may want to take profit or sell a stock is because you want to rebalance your overall portfolio. So before you go ahead to buy a stock, you may have a self-discipline or some sort of concrete rule in place which tells you that you must never let a single stock become more than 15% of your overall portfolio. This 15% number is something that I usually follow, but it can be anything that you're comfortable with depending on your risk level tolerance and how much risk you really want to ultimately take with your stock portfolio. So once you set that upfront before you buy a stock, If, for example, a stock price increases drastically and suddenly it becomes, say, 30% of your overall stock portfolio, then it's a trigger for you to start selling the stock, take some profit, and bring that weight down. Anyway, this is a really good risk management strategy that you can actually follow. A lot of fund managers follow it, and it will ultimately help you with minimizing your downside losses. And the second reason why you want to sell or take profit from a stock when it comes to your overall portfolio is because you simply found a better opportunity to invest your money. And rather than using cash that you may not have, what you might want to do is sell some of your winning stocks, take that money and reallocate them to new opportunities that you find attractive. And the third reason is because the stock in your portfolio no longer is helping you to achieve your overall portfolio objective or target. For example, think about dividends. If the target portfolio that you're managing needs to have some sort of dividend in place and the stock that you hold stops paying dividend, then it's a very good reason for you to actually sell out of that position. No harm done. And finally, and most importantly, one of the reasons why you want to sell or trim a position from your overall portfolio is because your personal circumstances has changed, or what you want to achieve from your portfolio has changed. It could be reasons such as you need the cash to make some emergency payment, or the fact that you no longer have a high risk tolerance for the type of stocks that was already in your portfolio. Now let's move on to reasons as to why you might want to sell or take profit from a single stock. So it's got nothing to do with your overall portfolio or you, but just the stock itself. What sort of reason would trigger you to start thinking about selling a stock? So the number one reason I can think about is a permanent loss of earning potential. This can come about due to change in regulations or even the change in business cycle. So think about coal policies, for example. You may have heard, especially from COP26, that a lot of developed countries like the UK are all trying to phase out of coal by 2030. And with the addition of carbon tax, companies that heavily use coal will get a massive increase in their cost base, which will ultimately impact their profitability. By the way, if you are interested, I do have a separate video talking about potential sell-off in the stock market that is coming from climate change and its policies. Do check it out at the end of this video. Moving on to the second reason as to why you may want to take profit or sell a company, and that is to do with excessive valuation. Valuation measures in stock investing tells you how to value a company in terms of earnings that it's making or even the book value of that company. So looking at things like PE ratio and PB ratio. For example, PE ratio tells you how much you are paying for per unit of earnings that a company makes. And the third reason why you may want to sell a stock is to do with the management of the company. So for example, there was a change in management, or the management is no longer making good or right decisions, and the fact that you actually start to lose faith in that management of company. Remember companies like Toys R Us or Blockbuster? My childhood was filled with visiting Blockbuster store every time I had some free time. I used to walk around the aisle and look out for new movies that was released so that I can take it home, borrow it, or even buy it. It seemed like a company that will never go bust. But it did, due to high level of debt and some really bad decision by the management. For example, did you know that the CEO of Blockbuster rejected to pay just $50 million to buy Netflix, which was its emerging competition? Although this is a very important reason as to why you want to sell out of a company, but this one is less applicable to retail investors like us because we don't have the luxury to meet the management of company one-to-one, talk to them and figure out what they're thinking. But if you do invest in active funds, that's what you're paying the fund managers to do. They have to go and talk to managements and figure out whether they are any good. So if you do invest your money in active funds, that's how you can get some value for your money. And the next reason as to why you may want to sell a company is because the company has lost its competitive moat, or it is no longer a leader in the industry that it operates in. Think about Kodak. Remember how we almost never use film photography anymore and that it's all digital. Kodak was a company that was stuck in time. Kodak shares, which had already dropped over 90% in 2011, closed down a further 28% just in a day after news broke that it had to file for bankruptcy. So look out for those arrogant companies and management that do not want to embrace change. And the final reason on my list as to why you may want to start selling some shares in a company that you hold is simply to take some profit, which is definitely a healthy thing to do. It could be that the company that you hold suddenly had a rumor, like a positive rumor, and the stock price went up by 20% in a day, which is not very sustainable. In that case, you may just want to take some profit and cash it in. Now, talking of profits, it's actually a really good idea to understand the difference or know exactly when to take profit and when to sell a stock outright. Remember that taking profit does not mean that you no longer have a strong view of the company. It's just some sort of short-term adjustments that you're making because the stock price have reached a point where it is no longer sustainable. So here are 3 reasons why you may want to take profit rather than sell a stock outright. The first one being, as I was mentioning, is simply the high current price, which may not be sustainable. Most recently, I have taken some profit myself. So when the Tesla stock reached above $1,000 mark, I thought it's time that I finally take some profit. And by that time, my return on Tesla was nearly 200%. So I was happy to take that profit, but it does not mean that I have reservation about the stock or I don't think it's gonna continue to do well. It's just simply I wanted to take some profit and keep that money to reinvest in other company that I thought would be quite good to enter at this point in time. And the second reason why you may want to take profit from a stock is simply because it reached and went above your price target. So, when you buy a stock with, say, $10, you must have some sort of number in mind, which is your price target. Like you want to sell the stock, or you'd be happy with the return if the price went up to, say, $20 or 20 pounds, right? So when that happens, it's perfectly normal to take profit. I have again done so myself, though. So there are stocks that I bought after the COVID stock market crash, and the reason why I bought it was not for a long-term investment purpose, but because I wanted to capture the recovery that stock is likely to have when the economy starts to recover. So when that happened, I sold. I don't think there is anything wrong with that. It is perfectly normal when you're happy with how much return you can see, or what your initial expectation was. It is perfectly fine to take some profit. And the third reason why you may consider taking profit is because you simply found better opportunity to invest your money in. So rather than selling out the stock you already have, you can take some profit from your winning stock and allocate them elsewhere. Again, I have done that myself most recently. So the profit I had from some of the COVID recovery stock, I have used that money to invest in TSMC stock because I thought it was a really good time and opportunity to enter and initiate a position in that company. Now, taking profit is completely different to deciding to sell a stock outright. And when you decide to do that, you must have some concrete reasoning behind why you no longer have any faith in that company or that stock, or why that stock is no longer suitable for you. And the simplest reason is a technical one, which involves using a stop loss strategy. Basically, you want to cut your losses. If a stock is down for a company specific reason and there is no clear guidance on whether that problem will ever be fixed, plus you don't have a high conviction on that stock anyway, then you may decide to cut your losses before they get bigger. Remember the chart I showed earlier is precisely for that reason. And the second reason why you may want to completely sell out of a company is because it's losing its competitive moat and is no longer a market leader. In this situation, you may consider selling it before the stock price starts to reflect the truth. Similar to this, other reason could be external factors such as the regulation changes or even the industry that the company is part of. Think about the tobacco industry. It's been on decline over the last few years. This is because regulations make it harder for them to advertise and sell. Plus, it simply became quite unfashionable. Although just 10 years ago, investors loved these companies because they were very profitable and always paid great dividends. They still do, but those dividends are hardly growing. And finally, you can completely sell out of a company simply because it no longer fits your investment thesis or belief. Take, for example, you are a dividend investor and you only buy stock that meets the criteria of paying out at least 2% dividend yield so that your overall portfolio dividend yield target can be met. And say you hold a stock that's already in your portfolio paying 3% dividend, and suddenly you hear an announcement from the company saying that it will start to cut dividend and only pay about 0.5% in yield. In this situation, it is perfectly normal to sell out from that stock because it no longer fits your investment philosophy or it's no longer suitable for you. Anyway, thanks to the person who recommended this video topic to me over at Instagram. I do always encourage and welcome your thoughts, your recommendations, or any sort of feedback that you may have on my videos. If you do want to talk to me or share some recommendations, then feel free to comment in the comment section below, or you can also reach me through Instagram or Twitter. That's all I had for today. Don't forget to like and subscribe if you haven't done so already. And until next time, do look after yourself and your money.